If you are looking to be a life insurance agent and you are out there in YouTube land trying to find all the tips, the tricks, the training, the tools that you need to pass the life insurance exam on the first try, you have come to the right video. Hello, my name is Ashley Mullinex and I am a final expense life insurance agent. And yes, I sell life insurance via telesales from the comfort of my own home. I am a mom, I am a wife, and I still have time to crush it in the industry and have my nights and weekends totally off. Today, I am going to share with you a key point that you need to understand for the life insurance exam. And a lot of times, at least I find as the type of learner that I am, I'm more of an audible learner. So I can read material, but it doesn't really stick unless I hear someone actually teach it to me. So today we are going to cover whole life. There are 3 main types, so let's dive in. All right, diving into it, whole life insurance. What do we need to know about this? Well, we kind of need to know a little bit of all of it, right? So let's jump into it. Whole life, there are 3 main types of whole life that I want you to be aware of. Okay, there's straight life, limited pay life, and the single premium whole life. These are all versions of whole life insurance. So let's jump into straight life. Straight life actually has a couple aliases. It also goes by ordinary life and continuous premium life. It gets the nickname continuous premium life because the premiums are always the same. If you enroll and your premium's $25 a month, whether you're 20, 40, 60, 80, it will always be $20 a month. So it is a continuous premium. It is the same amount every month after month. It does not change. Now, a couple key facts that I want you to be aware of, okay, when we're looking at straight life or ordinary life or continuous premium life. It is permanent, okay? So it's permanent up to the age of 100. If you look down at my graphic, at the bottom bar, age is the issue age where it starts, and then the max age is age 100. So no matter the health, the habits, or the age, this cannot be canceled. This is not your term. This does not end. This is permanent protection. The face amount is always level. So up here I have an example of a policy at $50,000. Whether they die at, like the example here, age 63, or whether they die at age 99, it will pay out the face amount, which is $50,000. Now, something to kind of highlight, I want to talk about my graphic here. Okay, we have the green horizontal bar. That is the cash value bar. Then you have the red dash, which is the premium. Like I said, it's a continuous premium. It is always set at the same amount, right? Forever. So if they enroll and it's $100 a month, it will be $100 a month every single month, month after month after month, until they reach the age of maturity, which is the age of 100. So the idea behind whole life is as you're making your premium payments, if you live to age 100, you will have paid in the full $50,000. So you are essentially paying for your own policy. But this is life insurance. This is a protection, right? You're not guaranteed to live to the age of 100. So when you get life insurance, if you notice, say you're making your premium payments and you're paying $100 a month, $100 a month, $100 a month, and bam, you pass away at the age of 63. If you look at my graphic, it shows at the age of 63, you would only have paid in $25,000 into this $50,000 plan. So how are you going to get the full $50,000 if you die at age 63? That's where insurance comes in. If you notice the pink area above, this is the gap that insurance is promising to pay. Insurance is saying, hey, whether you die a day after we issue the policy and you've only made one premium payment, you paid us $100 and you die, you're guaranteed to have the full $50,000. Or if you live to age 100, you just get the full $50,000 and everything's been paid. This is a umbrella, so to speak. This is a protection. This is you are not guaranteed or promised tomorrow. So have something in place and put some of that risk on the insurance company. Okay, if that makes sense to you. Now, another thing I want to highlight, going back, sorry about that. It does build cash value. So you can see how it grows and grows and grows. Every time you make a premium payment, a portion of that premium payment is going to build cash value. Now you can borrow against the cash value. If you borrow against the cash value, do keep in mind it lowers the payout amount. So for example, say you're paying your $100 every month, and by year 5, you've built up, we'll call it $5,000 in cash value. And you want to borrow $5,000 in cash value, and you take out a loan, and the following year, you die. Well, instead of the $50,000 being paid out, you took out a loan against the $50,000, you only get $45,000 back because you pulled out $5,000. So it does lower the death benefit when you do pay out. Your family will not get the full amount that you initially had in there because you were pulling out on it. And then again, it's a level premium. Your rate's locked in for life. The best time to get whole life insurance is when you're at your youngest and your healthiest. The big bonus here, it is not taxed. So a lot of people will think, well, I'll just throw $100 a month, into a savings account, into a CD or something like that. Well, that's great if you want Uncle Sam to put his hand in it, right? And take some of his cut. And also, again, you're not guaranteed to live to the age of 100 or to the age of 85. So insurance is there for a reason. And so if you guys got questions on any of this, feel free to email me. Happy to help out there. And then let's go to limited pay design. Limited pay. Again, this is also whole life, but it is just set up a little bit differently. If you notice at the graph over here, your premium payments on a limited pay stop at a certain age, okay? It still builds the cash value. It still functions like whole life. You can still borrow against it. And in this example, we're still looking at a $50,000 plan. So premiums will not be paid up to the age of 100. So in this example that I'm sharing with you, I put paid up to the age of 70, meaning this client, whenever their issue age was, they had decided to pay a higher premium so that when they are 70 years of age, they no longer have to pay anything, and they have the full coverage amount, they have the full coverage amount of the $50,000 because they have paid it up by age 70. So 2 different versions of limited pay. There is a 20 pay, which essentially means whatever the premium is that needs to be paid for the next 20 years, so that you will have paid in that full $50,000 will be your monthly premium. So when I say premium payments are higher with the limited pay, that's not a lie. They are just higher. And then the other version of limited pay is life paid up to the age of 65. And again, that just means that at the age of 65, you will be paid up and you no longer have to make a premium payment, and you have that umbrella. You have that $50,000 there for when you pass away. Yes, premium payments are higher. Cash value will actually grow faster with these plans. And this is really a good choice for folks who do not want to be paying a premium payment into their retirement. A lot of people, might make really good money in their working years, and they want that safety net for their loved ones, but they know that their retirement plan isn't going to afford them the same lifestyle. So they might want to have this paid up version so that they know when they retire at the age of 65, that's taken care of for them. Now, the last one, this is the most simplistic, in my opinion, of all the 3 main whole lives that we're going to cover, and this is single premium. Again, this is whole life. This is single premium. Single premium is just that. Boop, right there. You make a premium payment. This is a big premium payment, but you make a premium payment at the age of issue. This is also a level death benefit, okay? Meaning it is $50,000, and it is $50,000. No more, no less. It is level. And you make one lump sum payment, and then you have immediate cash value. So to keep it simple, it is just one payment. You get the full coverage amount, you have the cash value accessible to you, one and done. Think of single pay, one and done, and it's taken care of. Alrighty, so that is whole life in a nutshell with the straight, limited, and single premiums. I hope you found that video very helpful and insightful and that you got to learn and retain something new today. As always, hit that subscribe button for me. If you know other agents who are out there looking for material like this, please share it with them. Let's help others. That is why I create this content, is to help folks just like you so you can master these key points and become an agent and join us in this wonderful field, because it is amazing. And then also, if you are already a life insurance agent and you are struggling to find a good agency, a place to call home, a place where it is plug and play, where you have all the resources you need. You have the CRM, you have the booking bot, you have the training, you have the script, you have everything that you need. Apply for David Duford. Let them know that I sent you. Just put Ashley Mullinex down when you apply. If you have any questions, concerns, email me. I'm pretty quick to respond. And then also, I give away my script for free. So if you want to crush it, in the industry and you need a solid foundation, click the link below. Download my script. No obligation. I'll see you in the next video.